Hi, everybody. I would like to welcome you to our third research session of today. And it will be about macroprudential policies and financial frictions. We'll have two very interesting presentations, and the session will be for 1 hour. Okay, so I will suggest to stick to the same schedule, 25 minutes for presentation and 5 Q&A session. And I would like to present our first presenter, which is Marcin Kolasa from Narodowy Bank, Poland, and also Associate Professor of Warsaw School of Economics. So please.
Okay. Thank you very much, and I would also like to thank the organizers for including this paper in the program of this very interesting conference. I'm really very happy to be here. So the paper I'm going to present you is joint work with three of my colleagues from Narodowy Bank Polski. Krzysztof Makarski is one of them. He's also here at the audience. The paper is essentially about the boom-bust cycle that we could observe in several eurozone countries, and in particular, we try to look at this paper to what extent we could have prevented this kind of scenario. And the special focus will be on a special type of policy, which is called macroprudential policy, and especially a policy that is oriented at regulating the housing market. So this is a type of policy that have been implemented or is being contemplated in several countries, especially in the post-crisis environment. Some of the countries have already some success in implementing that. So we have a sort of retrospective question about that, whether things would have been different had this policy existed during the recent years. So I think the motivation is pretty clear. So we know that since the euro area was created, we've seen quite a lot of asymmetric developments in this region. So especially the so-called periphery of the euro area, by which I mean Greece, Ireland, Portugal, and Spain, has been very severely affected by various internal and external imbalances. And these internal imbalances were mainly concentrated in the housing market, and then they also spill over to many other sectors of the economy. And as we all know, this kind of developments almost toppled the common currency. So, as I said, these kind of developments are I would say probably well known to many of us. But let's spend a minute on just highlighting some of the most important aspects of this period. So here you can see the evolution of some key macro variables over time with the split of the euro area into the periphery, which comprises these four countries I mentioned, and the rest of the euro area, which I will call the core. So clearly you can see that the pace of economic expansion measured by GDP was far faster in the periphery. Also, the following collapse was also much stronger. But if you look at particular sectors of these economies, you will see that the housing market or the housing sector was this part of the economy where these asymmetries within the euro area were particularly stark. So if you look at housing loans or house prices, you see really huge run-up, huge expansion in the run-up to the financial crisis in the periphery. Not so much of that in the core of the euro area. And also, if you look at some external imbalances measured by the current account or net exports, you will see that actually foreign debt was growing pretty fast in the periphery of the euro area, while the core of the euro area was for most of this time was actually running a surplus. So these kind of developments I would say are well known, have been extensively discussed in the literature, and also I think it's pretty clear that common monetary policy, okay, because once you're in the euro area, there is just one interest rate that applies to all regions of the euro area, cannot really do very much in preventing this kind of asymmetric developments. So people started to look at some other tools. So like one type of policy that has attracted quite significant attention after this episode was like housing market-oriented macroprudential policy. And there are a couple of papers around on that, and the preliminary findings are, I would say, quite optimistic in that respect. Is that some people have shown that actually by appropriately adjusting the regulatory measures in the housing markets, you can improve the aggregate welfare in the euro area, and you can also stabilize quite a lot of, to a significant degree, the euro area. So what we try to do in this paper is essentially we sort of build on this literature and try to answer a question which sounds a bit retrospective, but actually looking at the most recent developments, especially in Ireland, this is a kind of episode that is not so unlikely to repeat itself, right? Because, for instance, in Ireland, the house prices have already increased by something like more than 30% from the crisis depth. So actually, it's not purely retrospective. So we try to see if adopting a macroprudential policy that regulates the loan-to-value ratio on the housing market could have at least, well, if not prevented, then at least mitigated these kind of scenarios that I was showing you a moment ago. So, and to this extent, we'll use a two-region model of the common currency area. We'll estimate that, and that is actually important compared to the previous studies because we'll be able to talk about some structural heterogeneity within the euro area. Okay, we'll show that these two regions actually differ not only in terms of size, but in terms of some important characteristics. And we'll also be able to look closer at this very historical episode that actually might be a bit different from the usual business cycle environment. Okay. And exactly what we will do, we'll also look at the common monetary policy, which will be optimized in a certain way, but especially at the region-specific macroprudential policy, because there is no reason why macroprudential policy cannot use instruments that are independent across the members of the common currency area. So this is more or less what we find. So some of this paper confirms what we sort of might have expected, which is that actually housing market shocks were very important drivers of these asymmetries that we've observed in the euro area. What we also find is that actually there are some structural features of the periphery of the euro area that actually make it more vulnerable to this kind of development. So it's not only that there is common monetary policy that responds more to the core, which is like the bigger part of the euro area, but there are some structural features that make this region, I mean the peripheral region, more vulnerable. And we have some results about the common optimized monetary policy, which turns out to be quite successful in smoothing output, but it can actually do pretty little about smoothing the boom on the housing market, and also very little about these external imbalances. While this independent optimized macroprudential policy is, in this respect at least, a bit more, well, not a bit, but significantly more successful. So very briefly about the model, just at least its most important ingredient. So this is a general equilibrium model comprising two regions of the monetary union. An important part of this model is that each of these regions is populated by patient and impatient agents, which makes them natural borrowers and lenders respectively. And an important part of this structure here is that these borrowers, these impatient agents, face a collateral constraint on their loans. So this actually means that the tightness of this collateral constraint, if it can be influenced by policy, this might be an important instrument here in providing some stability in this region. Otherwise, I would say it's like a standard model used in many central banks, standard production sector, and a bunch of nominal and real rigidities that people have considered, especially in estimated model, because eventually we are going to estimate this model so that it fits the data. So let me just, I have just only 2 slides with equations, so I won't bother you with that very much, but just just these are equations to show you some important terms showing up in this model. So this is the borrower's problem. So the problem of these guys that actually, that borrow and are relatively impatient. So they maximize utility that depends on consumption, on housing, and on labor. And there are some habits here, so there is probably nothing new here. But one of the shocks that is going to be very important is the shock that sort of affects the weight of housing in the utility. This is the shock that I'm going to refer to as the housing demand shock. So these guys are subject to the standard budget constraints, so they consume, they adjust their housing stock, they have to repay loans taken in the past, they can take new loans, they have some also wage income, but they are also subject to a collateral constraint, which essentially says that the repayment value of their loans taken in the past must not exceed a certain fraction, and this fraction is denoted by MK, and it will be one of the policy instruments, at least in our counterfactual experiments. So a certain fraction of the future value of housing. So it's a sort of like a LTV ratio, right? And it can be potentially subject to regulation. So we have two policies here. So one is common monetary policy, which essentially like is a Taylor-like rule with some interest rate smoothing. It responds to deviation of inflation from the target and from output and to the output gap. Where the relevant variables to which this common policy responds are some euro area-wide aggregates, except that when we try to optimize this policy, we actually do allow for the weights of inflation. I mean, for the weights of particular regions in inflation, in total inflation, and the same for the output gap, to be different from the weights implied by the population share. So the monetary policy might try to, for instance, respond stronger to, I don't know, like inflation deviations in the periphery than in the core, stronger than what is implied by the relative size of these regions. And macroprudential policy, so over the sample where we estimate the model, this is a constant parameters because this policy was not actually active during this sample, but during the counterfactual experiments we will allow this LTV ratio to respond to credit market development, so L is total credit, and to house prices, okay? So with some possibly negative coefficients, so there is some possibility for this policy to lean against house prices and credit developments. So the model is mainly estimated, but some of the parameters that affect the steady state are calibrated. I don't want to talk about calibration details, just the reason I'm showing this slide is mainly just to show where at least in the long run, these two regions of the euro area are different. Okay, so first of all, they differ in terms of their openness to their international openness. Okay, so the periphery is more open to international trade. This is like in line with what you see in the data, and also it's somewhat more leveraged in the long run. This is again something that you can see in the data. Otherwise, the economies, at least the long run features of these two regions are the same, except for size, of course, right? Because this is, by the way, one of the figures missing here. It's the periphery, at least under our calibration, if we use GDP as the measure of size, is the periphery is something like 16% of the whole euro area. So we use like some standard time series to estimate this model with a special focus on the housing market variables. We like construct some aggregates of the core and the periphery, use Bayesian methods, quarterly data for estimation, quarterly data running till the time when the zero lower bound started to be binding. The prior assumptions taken from the literature. So here is like, I would say that in terms of the number of variables included in estimation, the model is pretty rich. And I don't want to show you the very details of estimation, so let me just summarize it with just the following observation. So when you look at some particular parameter estimates, how they pairwise, in a pairwise way differ across these two regions, it looks like the periphery features is like more rigid, okay, than the core. So in particular, consumption habits are bigger in the periphery, so consumption will respond in a more sluggish way in the periphery than in the core. There are also, the wages are somewhat more sticky in the periphery, even though this difference is not so much important. What is more important is that the residential investment adjustment costs in the periphery are significantly larger. So what it essentially means is that the housing supply in the periphery is more rigid. Okay, this will actually have quite important implications for some of the results I'm going to show. And also as regards for shocks, because we allow for asymmetric shocks, the shocks are also different, and overall the shocks hitting the periphery are usually more inertial and more volatile. So just to illustrate to you how these different structural features of the core and the periphery perhaps make the latter more vulnerable to some housing booms. This is a plot that shows you the responses of these two regions to a common housing shock, okay, housing demand shock. So both of these regions are at the same time and in the same way hit by a housing preference shock. So absent any structural heterogeneity, so if these regions were identical except for size, you should see that the responses of the main macro variables in these two regions that are identical between these two regions. So you can see that this is not the case, right? So you can see that housing investment actually responds in a more sluggish way in the periphery. This also translates into a sharper increase in the house prices, at least on impact in this region, and this also translates into a larger expansion in GDP. So you see that this structural differences between these two regions actually usually really make these make the periphery more vulnerable to the kind of housing booms that have been observed in the euro area. So even though the shock is common, actually you will see, as you see it, the periphery ends up actually borrowing from the core, while if these regions were perfectly symmetric, even except for size, you wouldn't see these kind of developments. So these two regions also differ in terms of the importance of various types of shocks in driving the key macro and housing markets variables in particular. So there are several numbers here, but what I would like to point out here in particular is that the housing demand and also in some cases housing supply, or more generally housing market shocks, seem to be much more important in the periphery than in the core. Okay, so especially if you look at the house prices, but also at loans, housing loans, and GDP. So housing market disturbances actually matter quite more for what happens in the periphery. So let me now maybe starting from the, sorry, that's okay. So this is a chart that shows you how actually our model interprets what happened in the past in terms of the contributions of various types of disturbances that were hitting these two regions. So we have a bunch of shocks here that are grouped into several groups, and I'm starting from some housing market variables. So what is plotted here by solid lines is that the trended evolution of housing loans and house prices. So you see that the housing markets variables were to much extent driven by these housing demand shocks that I actually pointed out in one of the equations, and a similar case can be made for the house prices. So essentially, like housing markets variables are mainly driven by housing market shocks. So maybe this is not something very interesting, but a more interesting thing is how it translates into the behavior of other macro aggregates. So you see that housing market shocks also actually significantly affected the evolution of GDP in the periphery, and you will see that much of the economic expansion, and especially of the buzz that was following the financial crisis in the periphery, was actually due to housing market shocks. And as regards the external position, the picture is, I would say, somewhat similar, even though in this case some other shocks play quite an important role. And an interesting thing perhaps it's maybe difficult to see, but there is something that is called the risk premium shock. So in the case of net exports, actually one of the disturbances that is quite important for accounting for this growing imbalances in the periphery is the interest rate convergence that was observed before the euro area was created. Okay, so let me just now move to the last part, which is these counterfactual simulations. So how do we do that? We have these policy rules, monetary and macroprudential policy rules, and we optimize them in given the estimates that we've obtained over our sample, and we optimize them using the welfare criterion, where the welfare is defined in over the whole common currency area. So the criterion is weighted average of welfare in the core and in the periphery, where the weights correspond to the size of these regions in the euro area. And within each region is the sort of weighted average between these two types of agents that populate these two economies, so these patient and inpatient households. And so we optimize the rules, okay, using this criterion, and then look what actually some of the macroeconomic developments would have looked like had these rules been implemented just before the euro area was created. So these are the results of this such a sort of counterfactual policy experiment. First, using the monetary policy. So the main outcome here is these red solid lines show you the true data, but detrended, okay, and these black dashed lines show you the counterfactual scenarios with monetary policy that was optimized using this welfare criterion. So you can see that. What such a monetary policy can do, it can smooth the GDP in the core quite well, to a lesser extent, but still I would say significantly in the periphery as well. But especially if you look at the housing market variables and at the measures of external imbalances, it essentially does nothing to that. Okay, so you, with the monetary policy at least optimized in this way, you really couldn't have prevented the buildup of housing market imbalances and also of external imbalances. So the picture for the macroprudential policy is somewhat different. So in terms of GDP stability, maybe it's difficult to say something. So there are some cycles generated here, but clearly you can see that credit in the periphery, at least the peak of that was significantly cut. So I mean, this policy has a potential to actually smooth the credit cycle that was observed in the periphery. And also, if you look at the measure of external imbalances, well, it looks like these lines do not differ so much between each other, but you will see that, over the period of the building up of these imbalances, I mean, the degree of external imbalances in the periphery is significantly larger. So it really accumulates over these years into something like 20 percentage points in the net foreign assets position. So it's something actually quite. I would say the effect is quite big. The interesting thing is that when you look at the counterfactual path of the interest rate, is that actually, had you implemented this policy over this period, you would actually, at least for now, until now, you would have actually avoided the zero lower bound on the nominal interest rate. So the final thing that I would like you to take out from this picture is this is what actually the LTV ratio should look like if you want to implement this scenario. So you see that at some point actually the LTV ratio on mortgage loans would need to decrease even slightly below 50%. So this is a kind of the kind of movements in these instruments that you have to accept if you want to make this counterfactual scenario to materialize. So that's I think more or less it. So let me just conclude by saying that in this paper we offer some estimated two-region model of the euro area. We have shown that indeed the housing market shocks are very important drivers of the boom-bust cycle observed in the periphery. And to some extent, this what you've seen in the past is due to the fact that the periphery is somewhat more structurally more vulnerable than the core to these kind of scenarios. And the counterfactual policy experiments show that while the monetary policy, could do something about output stability, then not so much about internal and external imbalances measured by housing market developments and the foreign trade balance, while macroprudential policies in that respect at least looks more promising, at least from this historical perspective. So thank you very much.
Thank you very much, Marcin. Now we have time for 2 or 3 questions, so please, floor is open to questions.
Very optimistic about possibilities of macro instruments to limit the boom-bust cycle in European periphery, but now I am not so. But anyway, what do you think about driving forces of divergence in Europe? Maybe it's because of overestimated real convergence gains, and such overestimation of real convergence affect shifts in expectations about future incomes rising that affect motivation to borrow and more borrow for that affect housing market. What do you think about this? Thank you.
So the short answer is that perhaps these kind of considerations are not explicitly modeled here, but what you see here as a potential driving force, and which was also documented in some of the literature before, when you look at the period before the euro area was created, you did see some important interest rate convergence, right? So the natural interest rates in the peripheral countries were bigger, right, than in the core. Then you set up the euro area, and at least the short-term interest rates had to be equalized at that time, right? So you had for some countries it meant like a decrease in the nominal interest rates by a couple of percentage points, right? So what we find in this paper because this kind of mechanism is included here, right? But in our paper, at least according to our estimates, it matters. I wouldn't say a lot, but it affects significantly the buildup of external imbalances, right? So it is part of the story, but as regards the housing market developments, this doesn't seem to be the thing that was an important driver of these kind of events. But there are in these models there are rational agents, etc. Right? So part of the story might be true, even though we do not find any evidence for that.
I have a question. To what extent your result is driven by this exogenous differences in preferences of consumers? Can you endogenize it by introducing some other dimension, like income distribution?
This is maybe all shocks like this are exogenous in this model, so they might have served as a sort of shortcut for more sophisticated mechanisms, for sure, right? But we've experimented with several other specifications, so with some news shocks, etc. And it was always that these kind of shocks are really important. So far we haven't made any progress with that. And to the best of my knowledge, when we look at some similar papers, this is always like the main part of the story, right? So maybe this is indeed a kind of black box that it would be worth taking a closer look, or just But for now we just people started to like housing more. So it's
okay. Thank you very much.
Thank you.
And now I would like to introduce our second presenter. It's Igor Livshits from the University of Western Ontario. He also director of Belarusian Center of Economic Research and Outreach Activities. And he will be talking about sovereign debt sovereign default, and banking. So Igor, please, floor is yours.
Thank you. This is the first paper today that doesn't come with a disclaimer. Neither of the authors is an employee of a central bank or a supranational. So thanks the organizers for putting the paper in the program. Let's just get straight into it. So my co-author is Koens Horst of the University of Ghent. And this is a storytelling paper. This is, perhaps some of you will see it as a horror story. I guess I look at it more as a cautionary tale. And the story really goes back to the basics. And not like graduate school basics like undergrad. We regulate banks. Why do we regulate banks? Why do we have prudential policies? In the first place, banks play with other people's money, and playing with other people's money gives one incentive to take excessive risks due to simply limited liability. So banks are prone, people who play, agents who play with other people's money inevitably are prone to taking on excessive risks. What do we do about it? We regulate them. We make sure that they have enough of their own skin in the game by forcing them to hold some capital. Perfectly standard regulation policy. But if you will look at standard regulation policy, it has one other aspect. We typically go and identify certain securities and say, okay, these securities are safe, and you don't have to put your own skin in the game as long as you're investing in safe securities. So this is the whole idea of risk coefficients. And what's the kind of prototypical safe security? Security you don't have to back up with your own capital. Well, it's government bonds. And more, we come to realize that government bonds might not be as safe as they're made out to be by the prudential regulation. So this is a story of what happens when the prudential regulation says government bonds are safe and the government bonds aren't. And the story is going to be, well, what happens? The prudential regulation fails. We no longer prevent the banks from taking on excessive risks. They will take on excessive risks in a very specific fashion. Hello, sorry, I changed the slide on my screen, but not for you guys. There we go. My apologies. So that's the story I've been telling you about is kind of a little bit more on the screen now. I'll have to synchronize, I'm sorry. So when regulation fails, what happens is banks take on excessive risks, and these are very specific excessive risks. They load up on government bonds on things that are strongly correlated with. That's the story we're going to tell. The paper is a bit old, so we were motivated by very much developed kind of emerging markets episodes, and in fact, mostly Russia in '98 and Argentina in 2001. I'll be a little bit more specific about why those two. Well, Russia is because I was in Russia in '98, and I saw how much fun it is when this is the first default I witnessed myself. And once you witness a default, you never work on anything else. And Argentina just gives us a great, great anecdote. But the thing is, while we're working on the paper, we realized that this is not purely a emerging market phenomenon. What happened in Europe in especially in 2001 with LTRO, kind of made us think that the model we're going to write down is very much applicable to, well, unfortunately not just to developing markets. So the plan for today, I'm going to present as simple a model as I can that captures the story. Why bother? I already told you the story. Well, it turns out the model is going to inform us a little bit of the key insight of the model is going to tell us why this might be happening. And that is to say, the model is going to show that there is an incentive for the regulator not to adjust the regulation. And it's not just pure optics and politics. It's not just, oh, it looks bad. If the regulator and the borrower, the sovereign, are the same, basically the same thing, if the regulation of the banks is done by the same entity that's doing the borrowing, there is a moral hazard in banking regulation. There is an incentive for the regulator not to adjust the prudential regulation because it makes borrowing cheaper. Because those banks that are gambling by purchasing government bonds are willing to accept lower interest rate. That's kind of number one message of the paper. Number two message that's perhaps more relevant to Europe is it doesn't just come with the cost of making the crisis worse. It comes with another cost, and that is in the run-up to the crisis, or rather in this kind of pre-crisis episode, when the risk of default appears, but default hasn't happened yet, it diverts investment from productive uses, from kind of good projects into things that are correlated with government bonds. So those are kind of the two messages that the model is going to deliver that weren't, let's put it this way, ex ante obvious when I told you the story. All right? Sorry, I keep forgetting to switch the slides there. So that's the plan for today. I'm going to show you the very simple model. As simple as it gets. I don't think we're going to have the time to get into the extensions of the model, which make the model a little bit more realistic, make, more importantly, prudential regulations a little bit more realistic. We'll just do the kind of the bare bones, absolutely basic thing. And I'll show you that the two key insights are allowing the gambling lowers the interest rate the government has to pay. In other words, the gambling party really in the model is not going to be the bank. Well, the banks are going to be doing the gambling, but the real gamblers are going to be the regulators, the government. Depending on how much time we have, I'll show you a little bit of the evidence from Russia, the 1998 case, because we looked at the micro level data. So Russia had ample number of banks to run regressions with. So hopefully I'll have the time to show you the micro level evidence from Russia, and then we'll talk about what those things mean for Europe. All right, so that's the plan. The model. I'm going to make it as simple as possible. In fact, I'm kind of quite proud of how simple I made it. I won't even need derivatives. So, which means we're going to have to give up a lot of realism to keep things so simple. But it's going to be a really extremely simple model. There's going to be only three things one can invest in, or rather, the banks can invest in. And the three things are going to be the good, the bad, and the government. The good projects, that's where the investment should be going. The gambles, and the government bonds, because that's kind of the core of the story. What will make the gambles? I mean, the gambles are literally just lottery tickets with lower returns on average than the safe projects. What will make them attractive is only the limited liability on the banks. So investors themselves would never invest in them, banks might. The model is written down to generate the role for regulating the banks in the first place, which means that absent regulation, banking system does really bad things. It invests only in the gambles. But simple prudential regulation will restore first best and everything's going to be great as long as the government bonds are safe. And we'll talk about what happens when they're not. Same thing, only with a little bit of notation. So the good projects, they deterministically, this is just for simplicity, they deterministically give you a return of little r. The gambles either pay capital R, that's going to happen with probability P, or pay nothing. So now, key assumption, you can, as a banker, you can pick your risky projects as correlated as you want. So you could come up with a perfectly diversified portfolio. You'd never want to do that because that portfolio would give you lower return than a safe project. Or you could put all your eggs in one basket, make a perfectly correlated portfolio, basically just run one gigantic gamble. If you're a gambling bank, that's exactly what you want to do. Now, the society doesn't want us to do that because the average return on a gamble is lower than the return on a safe security. Of course, the upside is higher. That's why banks might be tempted to do so. Purely for notation, so I said the good, the bad, and the government. The government, just for notation, the rate of return, the return on government bonds, that is going to be endogenous. We're going to call it IG for government interest rate, okay? Now, the rest of the model, I'm going to force the households to invest through the banks. So nobody but the bankers can tell apart a risky project from a safe project. They all look like just, investments. So not the households, not the regulator. Only the bankers can tell apart the good from the bad. So as a result, all of the investment is going to go through the banks. The banks are going to be subject to limited liability, hence my moral hazard. And yeah, depositors, all that depositors can see basically is the only thing that's going to be observable is investment in bonds, government bonds versus just pile of investments. Bankers, of course, see what they're doing. Now, as I said, I'm going to keep it very simple, which means I'm going to make a lot of things exogenous. I'm going to make supply of deposits exogenous. You can think of this as coming from overlapping generations households, but bottom line, deposits in banks are taken as exogenous. Amount of government debt outstanding is taken as exogenous, and the amount of bankers' wealth is taken as exogenous. So those are my exogenous things, and given those, let's see how let's try to do the best we can. All right? I don't think I missed anything yet. Hello. There we go. So, what would we like to achieve in this economy? Well, obviously, we would like to have all of the investment going into safe projects, except for whatever we need to finance government expenditure, government debt, government deficit, if you will. That is, if that were to happen, what would the interest rates have to be in the economy? Well, the interest rate, banking is competitive. I said, bankers are competing with each other. So the interest rate offered to the households would have to be the same that the bankers are making on their investments. So interest rate in the banking system, little I, is the same as the return on these safe projects. And of course, the government would have to pay the same interest rate as long as the bonds are safe. Does this model deliver this outcome? And the answer is, well, absolutely not. If all the other banks are doing the right thing, me as an individual banker, what do I want to do? I want to go and run a gamble. Why? Because, well, if I lose, it's not my money, it's the households. And if I win, I make the difference between capital R and little r. So I only get the upside, I get no downside. And by the way, no household can tell that I'm actually gambling. So absent regulation, absent intervention, this model does not deliver good banking. So how do we fix things? Well, we force the banks to hold some of their own skin in the game. How do we do so? We say, well, really what we need is capital requirements. So force them to have some of their own wealth invested with the depositors' projects. For now, let's keep things very, very simple. We're just going to say, force them to have a fraction of, force bankers to own a fraction of investment. So B is going to be the minimal fraction of investment they have to own. And to keep, to bring the rest of my story in, so capital requirement is absolutely essential. What I'm going to call reserve requirement is not essential. But that's key part of my story, which is to say, well, let's treat the government bonds differently. So I'm going to say, okay, for now, this is not at all realistic, but I'm just going to force them to hold a certain fraction of the portfolio in the government bonds. I'm going to try to find time to fix that later. So the idea is that inequality there says, I can't force the banks to hold all of my bonds as a government. That's essential. If I can force them to hold all of my bonds, some people now call it financial repression, well, then the government's problem is simple. Just force the banks to hold your bonds. Done. To some extent, I'm thinking of what happens when the government ran out of that ability. They strong-armed the banks to a little bit, but now the last bond they have to place, the banks have to take voluntarily. Basically, they have to sell that bond on the market, which means I'll be able to determine the interest rate on that bond in equilibrium. Okay, so I want the interest rate on government bonds to be determined endogenously. That's key. So that is to say, there are more bonds out there than I can force the banks to hold. So my regulation right now has just two parameters. B, the fraction of the investment that has to be owned by the banker, and Q, the fraction of total portfolio that has to be placed into government bonds. And as long as that second inequality holds, second inequality says basically the loss from gambling exceeds the gain from gambling. As long as that inequality holds, prudential regulation does fine, it restores the first best, all the resources flow into safe projects and government bonds. Right? So things work, it's fantastic. As long as government bonds are safe, things work. So let's think of what happens when government bonds are no longer safe. And that really is like the one trick in the model that I'm kind of proud of. I'm going to keep things very, very simple by using one trick. I'm going to say that the probability of government default, and I'm going to take that also as exogenous, is the same as the probability of a gamble not repaying. So government bonds are going to look just like one of those gambles, right? And remember, I said there's a huge variety of gambles. You can all make them as correlated as you want. In particular, you can make them as correlated with government bonds as you want. So what happens when the government bonds are no longer safe? They repay with probability P and don't repay with probability 1 minus P. And the regulation doesn't recognize that fact. The regulation still treats the government bonds as safe. Well, oops, sorry. Government bond becomes just another gamble. And by the way, prudential regulation fails. Because it's now possible to satisfy prudential regulation, and run a gamble. In fact, in this basic model, things are even more dramatic than that. The only entities that satisfy banking regulation are gambling banks. You can't open a safe bank, it doesn't pay. Why? Because the market is full of banks that are gambling. They're all promising high interest rate that they will only deliver if there is no default. You can't credibly promise to run a safe bank because nobody sees your underlying balance sheets. So as a result, bankers who don't want to gamble, they just run private equity. They just invest their own money and don't take deposits. Why? Because they can't compete in the market for deposits. They can't offer sufficiently high interest rates. So interest rates in the market that are offered are high. But if you will, kind of not high enough, because there is a probability 1 minus P of default in the market. And that default happens to the government bonds and it happens to the banks. Banking system basically crashes whenever government defaults. So in this model, if prudential regulation is not adjusted, the equilibrium is very drastic. All of the funds of the households are funneled into gambling banks. They're put into government bonds and risky projects that are perfectly correlated with government bonds, and the whole system comes crashing down if the government defaults. So to me, that kind of sounded like Russia. All right? Now, so key point is you really can't open a safe banks because you can't credibly commit not to put the money into gambles. And the interest rate, the market interest rate offered to the household, of course it's only paid with probability P, is greater than the return on a safe project. So the only money going into safe projects are own capital of non-bankers, potential bankers who choose not to run the gamble. Now, as I said, key insights from the model. Well, key insight is really, let's look at what the interest rate is on a government bond. And the interest rate on the government bond, well, quite simple, government bond is just another gamble. There is a perfect substitute for it, the thing that's perfectly correlated with it. So what's the interest rate that the government has to pay? Well, same as the gamble that's perfectly correlated with it. So the government pays capital R. So 1 plus the interest rate on government bond is exactly the same as the return on the risky gamble. Notice that this capital R is lower than actuarially fair interest rate on the government bond. So if the government recognized the riskiness, if the regulator recognized the riskiness of the government bonds, even with risk-neutral investors, you would still have higher interest rate, R over P, on the government bond than if you allow the gamble. So basically, allowing banks to gamble makes it cheaper for the government to borrow. So who's the real gambler here? The government. So that's message number one. Message number two, we already covered that in the last slide. No investment of no household funds flow into good projects. So we're starving good projects of funds and instead putting it into things that are correlated with government default. Sorry, with government bonds. All right. So that's kind of, those are my two messages. 5? All right. What I don't have time to tell you is what happens when I make prudential regulation more realistic. So very briefly, what we do in the paper is we say, okay, let's fix two things. First of all, let's allow some safe banks to exist. The way we're going to do it is, as money floats out of the safe projects, the return on them increases. So we're going to have like a fixed measure of safe projects, and then the less we invest in there, the higher the productivity of investment. So this way, safe banks can now exist. The rate of return is equalized between safe banks, safe banks can promise the same interest rate as the gambling banks, only safe banks actually pay it all the time, and gambling banks only pay it every now and then. Households cannot tell the two apart. That's a minor thing. The big thing that we're going to do is we're going to say, let's change, the big thing we're going to do is we're going to say, let's change the prudential regulation. Hello, there we go. Let's change the prudential regulation to be much more realistic. And that is to say that we're going to make capital adequacy ratio depend on how much you're investing in bonds. The more you invest in visibly safe security, the less we're going to force you to hold in capital. So this is literally capital adequacy ratio with risk coefficients. And we're going to say that the risk coefficient in government bond is 0, which is completely standard practice. So even when the bonds are not safe, unfortunately. So what happens in that case, in the model? And what happens in the model is something very dramatic. Because the government bond becomes much better than just a gamble. The government bond becomes a gamble and the permit to take on a deposit. So the government bond becomes even more attractive. So in this economy, all of the interest rates are going up, except the interest rate in the government debt, which is actually going down. Government debt becomes even more attractive. The banks are willing to accept even lower interest rate. So bottom line, I view this really as a robustness exercise. The findings are very robust. In fact, making the model more realistic makes them even stronger. And the key finding is the government has strong incentive to allow the banks to borrow. To allow the banks to gamble because it makes borrowing cheaper. All right. So that's the basic story. Now let's do the anecdotes because life is, fun with anecdotes. Oh, part one. I almost forgot about Argentina. So, Russian government in 1998 might not be the most experienced or sophisticated government. Maybe they forgot to adjust prudential regulation. That's where Argentina comes in. They didn't forget. Because in 2001, in the run-up to the default, not only did they allow the banks to gamble, they changed the law on the pension funds to allow the state pension fund to buy government bonds, which were, of course, considered safe and, weren't. So Argentina is the clear case of the government explicitly changing the rules to allow the gambling. Now, did the banks, so the Russian, oops, sorry, too far, come on. The Russian example gives us a great anecdote and a way to check the story at the micro level. So when I went looking for Russian data, I was thinking of if I'm a Russian bank, what's correlated with government bonds? And I'm thinking Russian budget at that point, heavily in oil and gas, so, probably something, resource extraction. Russian banks are way smarter than I am. They found something as correlation 1 with government default, and that is ruble. So what did Russian banks get into? They got into what they called currency forwards. They're basically derivatives on currency futures. So quite plainly, Russian banks are promising to pay you money if a ruble collapses. Okay? How much of it are they promising to pay you? Well, in the case of income banks, 700% of their capital. Who's buying those promises? That's a different story. Perhaps LTCM. But bottom line, in fact, Ippolito has a really cool paper where he basically says, look, Russian default didn't kill Russian banks. Russian banks failed en masse, but they didn't hold enough bonds to bring such a bad crash. Ippolito says, default didn't kill the banks, gambling killed the banks. What we're saying is, well, come on, the two are very closely related. One of the reasons banks did that is because, well, those banks were perfectly satisfying prudential regulation. And in fact, what we're going to do is we're going to look at the micro level, at the correlation between holdings of this, between sales of currency forwards or foreign exchange liabilities on one hand and the government bonds on the other hand. What do we find? We'll find exactly what we're hoping for. In the run-up to the crisis, which is the first 2 quarters, we have a positive correlation which completely vanishes after the crisis. So it's in the run-up to the crisis that our mechanism is at play. It's much more pronounced for the private banks and foreign banks than for state banks, because presumably government has much stronger sway with state banks and can just twist their arms as opposed to use economic incentives. This is the same thing with regression. My favorite part of this table is look at the R-squares. They're pretty high in the first 2 quarters, and then once the crisis happens, it's all gone. So this is really is just a matter of correlation between the, GKOs are the government bonds, and this is trying to explain investment in government bonds. It's basically conditional correlation between government bonds and foreign and currency forwards. All right, I'm really out of time. What does it have to do with Europe? Well, unfortunately, possibly a lot. Bruti and Saure recommend repatriation of government bonds in Europe, and they think it's about endogenous costs of default. And this way you lower the probability of defaulting. We're thinking, well, who is much more willing to, whose prudential regulation makes it much more attractive to hold Italian bonds? Well, Italian banks. So we think that this repatriation may be a symptom of what we are talking about. And the most direct application of the model is to the LTRO, long-term refinancing operation, which basically said you can tell the banks in, let's call it peripheral Europe, Southern Europe, you can borrow from ECB as long as you put in a collateral with your national bank. National bank is in charge of figuring out whether collateral is safe or not. Well, guess what? Every single Southern European national bank figured that their bonds, their government's bonds are safe. And Acharai and Stefan document that a whole bunch of the LTRO funds that were borrowed went straight into buying the bonds of home countries. All right. What do we have to say about that? Politically, we understand that it might be necessary for ECB to support buying of the Southern European countries' bonds. But if you're going to do so directly. Don't destroy the banking system in the process, because when you're running it through the through the Southern European banks, you're making them invest not in productive projects, but in things that are correlated with government bonds. To ECB's credit, perhaps, LTRO only lasted less than a year, and well, for better or worse, ECB now is buying those bonds directly. What do we hope you take away from this? Basically, it's a cautionary tale of moral hazard in banking regulation. That if there is no distance between the regulator and the sovereign borrower, you have a moral hazard. In the words of Juvenal, which I thought belonged to Leo Hurwicz, who will guard the guardian? That's our story. Thank you.
Thank you very much, Igor. Now we have time for maybe a couple of questions.
I have some remarks. I'd like to tell a little bit our audience about the default of sovereign bonds, especially about local markets and about regulation. I'd like to all of you understand. All of you, that's why I'd like to repeat, I'd like to calm all our audience about sovereign defaults, especially in local currency and banking regulation. Because first of all our regulations, you know, it's so-called risk-weighted assets. That's why everything is really relative to each other. Governmental bonds in local currency, zero risk-weighted assets in our regulation. It's only like a starting point to understand other risks. That's why don't worry, because if country, frankly speaking, blow up completely, if government doesn't work, we have no any financial stability, means your total banking system will be destabilized and not exist. Means that when you compare all other risks, it's a minimum risk of local default in local currency. Of course, when we remember the Russian debt, which was mentioned here, when we remember the Argentinian debt mentioned here, it was in foreign currency only. That's why, of course, it's a very big risk for each particular government to have a debt in foreign currency. When we are talking about Greece debt, it's a different story, because be a part of Europe with such a huge deficit, it was absolutely not acceptable according to any Europe standard, according to any Maastricht agreement, but it's a different story. It's more about fraud than about default.
Thank you very much for comment. Yep, your question?
So in the model, you made the sovereign default exogenous, but one kind of interesting mechanism is kind of a bailout of banks in a bad state of the world that might become too large for the government. So I was wondering if the model would work out with that source of risk for government bonds.
Thanks. That is absolutely a great idea. And so let me be clear as to what's in the paper. Paper has one extra twist. It's actually in the backup slides, but we're not going to go there. We can think about, we literally have a two-period example of where we show that allowing banks to gamble might allow the government to gamble for basically gamble for redemption. It might allow you to not default right. The choice might be between defaulting right now without taking the banks down with you, or running a gamble into the next period, where next period you're going to take the banks with you. That's what's in the paper. That you can do right here easily, but that's not, I think your idea is much deeper, and that is, I've now come across the term doom loop. This is one side of a doom loop. This is how government default makes, how the risk of government default combined with improper regulation makes the banks take on a lot of government debt and other things that are correlated with it. This is missing entirely the other side of it, which is if the banks fail, the government might have to bail them out, and that increases the probability of government default. 3 years ago, Virala Charai and I had a kind of chicken and egg discussion, kind of what came first. Luckily, I think now we're at the point where we're starting to work on models where we do this explicitly. We are not there. So we stopped short of that. But I do think that some of the more interesting applications are really this presumably can be embedded in these models of doom loop where you do close the circle. I think it's a great idea. We haven't done it here.
Thank you very much, Igor. Now I would like to give a round of applause to our presenters. Thank you.